Afsaneh, let me start with you. As I said, it looks like right now the equity markets, by and large, just go up. How do you invest into that market as a practical matter? Because it looks like we're investing almost in the government, in fiscal and monetary policy, and some vaccine, not in the companies themselves.
You're absolutely right, David. It has been seeming like that, but there are many new players in the equity markets, as we've seen also in the last several months, in the last year, as the power of the retail investor has become also very different. The interesting thing that is going on with the institutions, though, is that as they saw last year, some of them were sitting a little bit on the side of the market, and they're seeing that momentum is very important. And that's why you're seeing not just the retail, but big institutions also keeping additions to their equities. The only thing I would say, David, though, is I think actually stock picking is coming back, and it's not just going to be the index funds that will matter. In fact, if anything, it will be much more important to choose stocks, even though you have this kind of momentum, because you could also get killed if you're in, let's say, oil stocks versus renewables.
So, Steve, you have a lot of money that you have to put to work. Do you agree with that, or is Warren Buffett right that basically for most investors, you should just be betting the market?
Well, I actually probably agree a little bit more with Warren Buffett as far as individual investors are concerned. But let me just go back and agree with what Afsaneh just said and add a little bit of how we think about it. First, I think when you talk about what the government's doing and the stimulus and all that, I think what's really put a floor under this market are interest rates. And as when the S&P dividend yield is higher than the interest rate on the 10-year, it's easy for people to say, well, why wouldn't I just take the S&P dividend plus hopefully some appreciation and so forth? And so when we think about the market, one of the things we keep an eye on is whether interest rates are going to start to rise. High interest rates are the enemy of the market. In terms of the valuations and it going up and up, interestingly, corporate profits have held up surprisingly well during this period. And in fact, in this current earnings season that we're right in the middle of now, something like 70 or even 75% of companies are beating expectations. And so there are real earnings coming through for many of these companies. And the third thing I'd say is that as we talk to our managers, and most of our money, as you know, is managed by specific specialized funds that have a specific area of interest, we have rarely seen so much enthusiasm, bullishness, if you want to call it that, about the market. In addition to what I said about interest rates and so forth, and earnings coming through, what our managers are seeing is this $1.6 trillion of pent-up demand, of excess savings, of dry powder, whatever you want to call it, that Jason Furman and Larry Summers has talked about this a bit as well, that many of us expect to become unleashed as the virus becomes less of a fact. People get vaccinated and start to go out and have all the things to do that they didn't get to do and now want to do, and the cash to do it.
So, Afsaneh, pushed together two things that Steve just talked about. One is Larry Summers and Jason Furman. Also, I'll add Olivia Blanchard, warning actually about the possibility of inflation coming back as we keep pumping money into the economy and the interest rates being the enemy of the market. Is there a risk as an investor, do you need to take that into account, a risk that inflation may drive up interest rates and change the complexion of the market?
Absolutely. That is something that we watch very closely. As you know, actual reported inflation at the moment is incredibly subdued. There was just a number the other day, and there's really no sign of anything. But that's not surprising. We're still in this kind of partial lockdown. But when you look ahead at inflationary expectations using treasuries and tips and all the calculations you can do, inflationary expectations have moved up a bit. They are now in the 2% range when you go out 1 year. And that's fine because that's the target. But it is something we absolutely keep a close eye on.
Afsaneh, what about RockCreek?
It's really interesting because both Fed chairman and the European Central Bank are basically saying I don't want to say they don't care about inflation rates, but they're not concerned. They're not going to be moving to do anything different than what they've been doing. So that, I think, is very indicative of what's going on. In terms of, we also look at Japan as a really important sort of historical fact, how hard it has been to push up inflation. Obviously, the kind of numbers in terms of our stimulus plan that we're talking about right now, plus what we will be talking about very soon, hopefully, which is on the infrastructure fund, front will be very important in terms of pushing inflation maybe in some areas, but let's not forget, it's also the fact that inflation itself, the way we measure it, everyone knows, is problematic.
Steve, Afsaneh mentioned infrastructure, and that takes us to what President Biden calls his Build Back Better. That's not what we're talking about with the $1.9 trillion. That's something next. Is there going to be room, fiscal room, to be able to do that? And that takes us back to what you said. A lot of people are very bullish on the market. Are they bullish on the economy, Steve?
In terms of the question of infrastructure and fiscal space, and obviously everything that Larry's been talking about, first, I would associate myself completely with everything he's been talking about. And since they're his thoughts and he says them well, I won't repeat them all. But in terms of fiscal space, yeah, we do have essentially unlimited fiscal space. I don't think there's any real danger that the credit markets are going to throw up at us and say, we're not going to lend you money anymore. The question is, what is it prudent to do? These deficits, in my view anyway, really are an intergenerational transfer.
Briefly, Afsaneh, Steve identifies himself with what Larry Summers has said. I'm not sure you do.
You know, I agree with lots of things that Larry says, but I think on this back and forth in the last week or so, I would be in a different camp. I do feel like we should be really concentrating on the third of the population that is hurting. And instead of worrying as much about targeting to the decimal point, start thinking about how we get that part of the population up to a very different level. So we can say that, you know, for example, how much is going to reopening schools or education is too much. But we know how far back our education has fallen just in the last year. The needs are much bigger, I think, than people realize. And I think if we could, as economists, start concentrating on the bottom half versus getting distracted on the minutia on the targeting, we would get the economy to a better place, because those people will have a higher demand and will spend more. And so that also takes me to sort of this whole argument about the $15 wage. Somebody will have to pay for people to have a certain minimum level of living. So it's either the government or whoever's paying their wages.